Right now, somewhere in the UK, a pensioner is turning their heating down to save a couple of pounds a week. They think they have to. They don't. The government has money set aside for them, money they've already paid for over a lifetime of work, and they're not claiming it. The average award is worth £4,300 a year. For people in certain situations, it's much more, over £7,000, and around 910,000 households are missing out, leaving up to £2.5 billion unclaimed every single year. By the end of this video, you'll know, in plain English, whether some of that money belongs to you and exactly how to claim it, even if you've got savings, even if you own your home, even if you tried years ago and got turned down. Stay with me, because two things decide whether you get this money or not. The first is one belief that stops most people even applying, a belief I'll prove wrong with the government's own figures in just a moment. The second is a line, a threshold that most people think is fixed, but for certain situations, it quietly moves in your favor. If you don't know where your line really is, you might be walking away from thousands of pounds you're entitled to. I'll show you a real example from the government's own official guidance. A woman receiving over £139 a week in pension credit on top of her state pension. Most people in her exact situation never claim a penny of it. But first, the basics. What we're talking about is called pension credit. In plain English, it's a top-up. If you're over state pension age and your weekly income is on the lower side, the government tops it up to a guaranteed minimum. For the 2026 to 2027 tax year, that minimum is £238 a week if you're single, £363.25 if you're a couple. If your income is below that line, pension credit pays the difference. There's no catch in the maths. But, and this is the key, the weekly cash isn't even the biggest prize. There's something pension credit unlocks that's worth far more than the top-up itself. I'll come back to it because it's the part most people completely miss. Right, that wrong belief I promised you. It's this: I've got a bit put away. There's no point applying. That single sentence costs people thousands. Here's the truth, straight from the government's own rules. The first £10,000 of your savings is ignored completely, not reduced. Ignored. Two people in identical situations, one with nothing saved, one with £9,500 in a cash ISA, get the exact same calculation. The savings simply don't count. But what if I've got more than £10,000? You're still very likely to qualify. Above £10,000, the rules don't look at the real interest your money earns. They use a simple rule. For every £500 above the 10,000 line, they add £1 a week of what they call deemed income. Let me make that real with numbers, slowly. Say you've got £20,000 saved. That's £10,000 above the line. It counts as just £20 a week of income. Say you've got £50,000 saved. That's £40,000 above the line. It counts as £80 a week. There is no upper savings limit that automatically shuts the door. Let that sink in. People with 20, 30, even £50,000 in the bank can still qualify for pension credit. The savings myth is the single biggest reason that £2.5 billion is going unclaimed every year. Now, while we're knocking down myths, let me clear 4 more, quickly, because one of them might be the one stopping you. I own my home, so I won't get it. Owning your home does not rule you out. I've got a small private pension. A modest private pension doesn't rule you out either. It just counts as part of your weekly income. I tried years ago and was turned down. The thresholds rise every April. Your circumstances change. A no 3 years ago is not a no today. And the quietest one of all, I don't want a handout. This isn't a handout. You paid into this system your whole working life. This is money the government has set aside for exactly your situation. Leaving it unclaimed doesn't help anyone. It just means you go cold when you don't have to. Right. Myths cleared. Let's find out if it's actually you. 3 quick questions. 1. Have you reached state pension age? In the UK, that's currently 66, though it's rising gradually to 67 between April 2026 and April 2028. If you're 66 or over, keep going. 2. Add up your weekly income. That's your state pension, any private or workplace pension, any earnings. Important. Attendance allowance, PIP, and DLA do not count as income here. Leave them out of the total. 3. Is your weekly income below £238 on your own, or £363.25 as a couple? If you're below the line, you're very likely owed money right now. If you're within about £30 of the line, apply anyway, because of that second thing I mentioned, the line that quietly moves. I'll show you what that means in just a moment. But first, let me make all of this real, with an example straight from the government's own official guidance for advisors, published on gov.uk for April 2026. Meet Joyce. Joyce is 70. She's single, and she lives alone. Her state pension is £184.90 a week. She also gets attendance allowance of £114.60 a week. But remember, that doesn't count as income for this, and she has £8,000 saved under the 10,000 line, so it's ignored entirely. Now watch what happens. Because Joyce lives alone, gets attendance allowance, and nobody is paid carer's allowance to look after her, her personal minimum isn't £238 a week. It's lifted to £324.05. Her only counted income is her £184.90 state pension. So her pension credit is £324.05 minus £184.90, which comes to £139.15 a week. That's over £7,000 a year on top of her state pension. And the working is straight from the government's own published example. Most people in Joyce's exact position never claim a penny of it. The reason her minimum jumped from 238 to 324 is what I called the second trap. So let me open it up now. This is the part hardly anyone understands. The £238 figure is not fixed for everyone. For certain circumstances, the government raises the line you're measured against, which means people who look too well off on paper actually qualify when you do the proper sum. There are 2 big additions. The first is called the Severe Disability Addition. It's around £86 a week added to your minimum. If you get a benefit like attendance allowance, you live alone, and no one is paid carer's allowance to look after you. That's the addition that pushed Joyce from 238 up to 324. The second is called the carer addition, around £48 a week if you care for someone. And here's the part that catches people out. You can sometimes get this even if you've been told you can't be paid carer's allowance because your state pension is higher. The rule is something called underlying entitlement. If you've ever been told you qualify but can't be paid carer's allowance, that doesn't mean nothing. It can still increase your pension credit. So if you, or someone you're watching this for, has a disability or is a carer, that £238 threshold could be a lot higher than you think. That's why "I'm a bit over the limit" is so often completely wrong. Now, the part I promised you at the very start. The reason pension credit matters even more than the cash itself. Pension credit is a gateway. Being awarded even £1 a week of it can unlock a whole chain of other help. This is where the real value lives. A reduction on your council tax. In many cases, up to 100% off the bill. The warm home discount on your energy. Help with NHS dental treatment, glasses, and travel to hospital appointments. Housing benefit if you rent. And if you're 75 or over, a free TV license. Read that list again in your head. £1 of pension credit can be the key that opens between £1,500 and £3,000 of other support every single year. That's why writing it off as only a few pounds a week is the most expensive mistake of all. The pound isn't the point. The door it opens is. One warning before we get to how to claim, because this catches people out badly. If you're a couple and one of you is under state pension age, what's called a mixed-age couple, the rules changed in May 2019. You generally can't make a new pension credit claim until both of you are over state pension age. In that situation, you'd usually need to look at universal credit instead. If that's you, don't just give up. Get free advice. The right benefit depends on your exact numbers, and there are organizations that will help you work it out for nothing, right? Here's exactly how to claim. There are 2 ways in. The phone is easiest. Call 0800-991234. That's Monday to Friday, 8 in the morning to 6 in the evening. The call is free from most phones, and the person on the line fills the form in with you. You don't have to do it on your own, or you can apply online at gov.uk/pension credit. Either way, have 4 things ready before you start. Your national insurance number, your bank details, a rough note of your weekly income, and your total savings. The whole thing takes about 20 minutes. After you apply, the DWP writes to you with a decision. If you're awarded it, the money goes straight into your bank account, and so do those gateway benefits, often automatically. And here's a piece of money most people don't know about. A new claim can be backdated by up to 3 months. So if you were eligible during those 3 months, your very first payment can include the money you'd otherwise have lost. Which means, and please hear this, delaying even a single week can cost you real money. The smart move is to check now, not after the weekend, not when I get round to it, now. One quick protection before we finish, because where there's money, there are scammers. The real DWP will never text you, will never call you, asking for your bank PIN, your password, or any kind of upfront payment to release your pension credit. If anyone contacts you asking for those, it's a scam. Hang up and use the official number you saw on screen, 0800-991234. So, 2 things to do today. First, if there's any chance that income line applies to you, make the call. Worst case, they say no, and you've lost 20 minutes. Best case, you're a Joyce, and it changes your whole year. Second, and this matters just as much, think of one person, a parent, a neighbor, a friend who's gone quiet about money lately. Send them this video, because the people missing out on this are, almost by definition, the people who don't know it exists. Today, you could be the one who tells them. Now, remember Joyce's attendance allowance? The one that didn't count as income? That benefit pays out up to £5,740 a year on its own. It doesn't touch your savings, and most people who clearly qualify never claim it because of one myth about who it's actually for. That's the next video. And it's the single most underclaimed benefit after pension credit. Subscribe so it lands in front of you when it goes up, because these rules change every April, and the people who stay informed are the people who don't get left behind. This channel is for general information only. We are not affiliated with the DWP, HMRC, or any government body, and nothing here is personal financial advice. All figures are 2026 to 2027 rates and can change, so always confirm your own situation at gov.uk or with a free advisor such as Citizens Advice or Age UK.